Hello and welcome to Chapter 10. Chapter 10, we're going to discuss stockholders' equity and the different elements of stockholders' equity. In this particular chapter, we're on the last part of the balance sheet and we're working our way down to the last pieces that you'll see on the balance sheet. And so here's what we're going to cover in Chapter 10. We're going to look at the differences between common and preferred stock and how you use those in creating capital. How to record capital stock transactions, which is going to include common stock, preferred stock, and also something called treasury stock. We're going to look at the differences, talk about how to account for the distribution of assets to stockholders. We're going to describe the accounting issues related to retained earnings and something called accumulated other comprehensive income. And other comprehensive income is things that may not go through the income statement of an organization. And we're going to talk about how the different payout and profitability ratios of stockholders. And really, that's as much what happens with finance people trying to understand what's going on with stock within a business. Stockholders' equity, typically referred to also as equity, are the claims that the owners have against assets. And it's in the equity section of the balance sheet, and there's multiple elements to it. First one is capital stock, and the capital stock can be divided into preferred stock and common stock. And a lot of times they collectively are referred to as additional paid in capital, and or paid in capital, and then additional paid in capital is another account that goes along with those. You have retained earnings or deficit. And typically you're going to see retained earnings, but sometimes you'll have a deficit, which means that the company has lost money, maybe in one period, a significant amount of money, or has lost money over an extended period of time. Accumulated or other comprehensive income is the next thing. We'll cover that a little bit later. And treasury stock is when the organization buys back their stock for multiple reasons. Most large organizations are really established using stock. And the reason they do that is they want to limit the liability of their ownership. And the other thing that's interesting, and you might go back and take a look at some of the advantages of a corporation, but one of them is transferability of ownership. And what they do is they can divide the ownership of a corporation into a large number of shares. And what that does is it allows for them to raise a whole lot of capital. And depending upon who the shareholders are, you can have large shareholders or small shareholders. Most of us are going to be small shareholders, but you might notice, for example, or think about somebody named Warren Buffett from Lincoln, Nebraska, where he owns a whole lot of shares of several different companies, and that's how he makes his living. But for the most part, you're going to have a lot of small shareholders. Sometimes they call larger shareholders institutional investors versus individual investors. So, how does a corporation decide what to do to issue common stock? Well, what they do is they're authorized when they become a corporation, they get incorporated in whatever state they're going to be incorporated in. And typically, you're going to see a lot of them incorporated in Delaware, and it has to do with the laws in Delaware as far as how they get to establish corporations. And yeah, I don't, but it's the laws in Delaware. And in that, they have a corporate charter, and what the corporate charter says in the articles of incorporation, it tells them how many shares of stock that they can purchase and what the whole purpose of the organization is and that sort of stuff. And they use that corporate charter to guide what they're going to do. And it tells them, like I said before, how many shares that they can sell, and also that's the authorized shares. And then there's something called issued shares. This is the third point on this slide. Issued shares are the ones that they've issued. They have a certain number. Maybe they have 100,000 shares authorized, but they've only issued 10,000 shares. So that gives them an opportunity to issue more shares of stock at a greater date. And outstanding shares is really going to be the shares they've issued and they're still outstanding. The difference typically is treasury stock, which we'll cover a little bit further as we go. And this bottom point is what that's really talking about is treasury stock, where it says when firms reacquire their own stock, the reacquired shares are not considered to be outstanding. And typically they're going to be treasury stock. So how do you determine this? Let's start from the left and work our way to the right. In the Articles of Incorporation, this particular organization was authorized to sell 500,000 shares of stock. The what they did is they ended up issuing 200,000 of those 500,000 shares. In the next period, or the next slide on the slide, they actually bought back 10,000 of those shares. And typically they're going to buy those back for one or two reasons. And this is where I was talking about treasury stock. They're going to buy those back to maybe if they have an employee stock ownership plan, or to increase the value of their stock because there's this supply and demand where they think maybe their stock is undervalued and they want to reward their shareholders. And then what they did here is they authorized them to issue another 50,000 shares. So you take these two 50,000 shares and you add them together, so you get 250,000. That's where this number comes from. But it appears as though they still hold 10,000 shares of treasury stock. So they have 500,000 authorized, 250 issued, but only 240,000 outstanding. So those are the differences, and that's kind of a key determinant when you look at some of the things for stock. And it can be either common or preferred. So common stock by its nature is really common. And you think about the one example I like to think about is if you're boarding an aircraft, and they say if you're an Advantage Gold member or Platinum or Double Platinum, you get to board first. Well, those are preferred customers on an airline. Well, common stock are going to be like I said, they're standing in the last few. We're the last to board, and we get the worst seats and everything else. That's basically what common stock are. But what are the rights for common stock? Well, they can vote on the election of a board of directors, and they can recall the board of directors. They have um, they get to share in the profits and dividends of the company, and we'll touch on that a little bit more here in a little bit. They have something called preemptive right, which what that does. A preemptive right says that they can maintain their same percentage of sales or percentage of ownership in stock if an organization decides to issue more shares. So let's go back to our last example that we just touched on, where we had 200. Remember, we had 200,000 shares outstanding, and then they went out and they issued another 50,000 shares. Well, if you had 25% of those 200,000 shares, which would be about 50,000 shares, and the company issued another 50,000 shares, the preemptive right would say that you can get another 12,000. They have to give you the right of refusal to buy another 12,500 shares. The reason they do that, I think, is back in history, an organization, if they had people that were trying to do, say, a corporate takeover or buy the corporation, or they wanted to dilute the ownership of some of the shareholders, they would just go issue more shares. So I guarantee you, this preemptive right um, was established so that shareholders or organizations couldn't do that. And this bottom one here, which you never really want to have happen, is they can share in the liquidation or their proportion of the shares. But remember, what happens is in an organization, typically common shareholders are the last to get any liquidation shareholder preference. Typically, it's going to start off with debt holders, then it's going to go to preferred stockholders, then it's going to go to common. So the odds of you getting anything back if you own common stock and an organization liquidates are pretty low. So how does a stockholder make money? It doesn't say it this way, but I think it's the easiest way to say this. How do you make money as a stockholder? So there's one of two ways. The first way is the first way is price appreciation of the stock. Typically, you hear finance people say buy low, sell high. So what does that mean? That means you want to buy the stock at say $10 a share and sell at 20. So you're buying at the low point and selling at the high point. And you make the difference when you sell this stuff on an open market like the New York Stock Exchange or the Nasdaq. You make money on the difference in the price of the stock from what you paid for it versus what you sold it for. And obviously the same holds true. You can lose money based off of that as well. The next thing is dividends. And a dividend is a distribution of profits from an organization. And it's voted on by the organization. And they have to have enough money to pay a dividend, but basically it's a distribution of profits. And typically they're going to say a dividend is 50 cents or 75 cents or $1 per share. And they're quarterly dividends for the most part. And that's how they make money. So you make money one of two ways: buy low, sell high, if you will, and a distribution of profits, if I were to change these terms a little bit. Preferred generally pays a regular dividend. And it's similar to debt because what happens is when you buy preferred stock, it's going to say preferred stock with a par value of 100 and a 7% value. 7%, it'll say 7% preferred par value preferred stock or something along those lines. And essentially what it says is if the organization declares a dividend, you're going to get 7% of the value of what you paid. And it's very similar to interest, but it's not interest. And in preferred stock, the value of it is really tied to interest rate and the overall credit worthiness of a business. And it's a less risky investment than preferred stock, but also you're capped on what you can get on profit, either as a distribution or the increase in share of the price appreciation that we just talked about. But the one thing that's kind of interesting down here is this last one that said they get preferred or priority distribution of dividends over um, common shareholders, and it also says this in the event of liquidation. So look at the differences. What are the advantages? You have dividend preferences. You can have a conversion for preferred stock into common stock, and liquidation if a company is dissolved. And on the advantages for common stock, you have a call provision where they can buy and repurchase the shares, and they can deny voting rights. Pardon me. A par value on common stock is really just a monetary amount of money, a nominal amount of money, and it's not used to determine the market share. But what happens is we use that par value number to determine a distribution of how you make the journal entry when you sell common stock or preferred stock for that matter. So, for example, a typical value might be a par value of $1 for common stock. Let's say you sold 100 shares of common stock with a par value of 1, and you sold them for, say, $15 a share. So if you sold 100,000 shares, you're going to take $15 times 100,000, get you $1.5 million. So that's how much cash came in. So you would debit cash for 1.5 million. You would credit common stock for 100,000, which is 100,000 shares times the $1 par value. The remaining 1.4 million is going to go in this account down here. It says it's additional paid-in capital, and what it's going to say is paid-in capital in excess of par value common stock if you sold common stock, or preferred stock if you sold preferred stock. And they're going to be in the equity section of the balance sheet. So I'm going to show you this slide, and you can kind of take a look at it. And you might want to pause your slide here. You can read through this, and we're going to look at the journal entries on the next page. So you can see what happens. They're going to issue some stock, and what we want to do is how much did they get, what are the journal entries, and what does it stockholders equity section look like on the spectator's balance sheet. And let's take a look here. So the first thing is they sold 200 shares of preferred stock at $22 a share. So $4,400, and they sold 2,000 shares of common stock at $250 a share. So they get a total of $54,400. What we've done is we've divided this journal entry into two. The first one says, look, here's the 4,400 from up here that they got. This 4,000, the par value of preferred stock must be $1 per share. So they took $2 $20 per share. Because if you take this $2 or 2,000 shares and you multiply times $20, that's going to give you $4,000 here. And the difference between the two is in this additional paid-in capital preferred stock of $400 per share. On the bottom one, they sold 20,000 shares of common stock. There's your 50,000. They had common stock 40,000 here. So if you notice 40,000 divided by 20,000, their par value must have been $2 per share. And then the difference is 10,000 that goes in additional paid-in capital. And you can see the calculations for the par value down here. But I wanted to also verbalize those for you guys because sometimes you're a visual learner and not a auditory learner, or vice versa. So I wanted to talk about both of these together. So this gives you an idea of what's happening. And now here's the stockholders' equity section, common and preferred, and then the paid-in capital for both. And they have 54,400. And you notice there's a zero here. They said this. it tells you that it's a newly formed corporation. Typically, there's going to be some kind of dollar amount here, plus or minus. The odds there to be a zero there is pretty low after an organization has been in existence. Even a even a even a month, the odds are pretty rare that it's going to be zero. So you notice here there's another one that says stated capital or no par stock. Well, first let's talk about stated or legal capital. This has the exact same character as what we just talked about with par value. The only difference is where you had paid in capital in excess of par value, it might say paid in capital in excess of stated value. This next one, the no par stock, if we go back to this presentation, let's go back to here. If we had no par stock, this 400 would be included here, and you would not have this $400. It would be 4,400 and 4,400. If you so that's no par. If you had stated value, it would look just like this, but this would say additional paid in capital preferred stock, and it would actually say at the end of this in excess of stated value. In excess of stated value would say the same there. So that's the only real distinction between those, and that's what I'm talking about here. And and it tells you that in this last thing that's recorded exactly the same as what we talked about before, and it has the exact same character as par value, stated value. A warrant, a stock warrant, is granted by a corporation to purchase a specific number of shares of its common stock at a stated price within a time period. Why do they do this? For two situations. They make it they issue warrants along with bonds or preferred stock as an equity kicker. In other words, to make them more attractive to someone to buy. And they might want to have issue warrants to existing shareholders so they can buy a specific share of stock and issue it. And usually their duration is only about 6 months. Options are a little bit different. Options they grant employees or executives of a company a right to buy shares of stock, and it's really set at a price, and it helps them with their compensation, and it gives them those rights to buy stock. And what they do is they actually, it doesn't say it here, but they have, yeah, here, there's a strike price. What they do is they give them a strike price at what they can buy. So let's say you get an option to buy stock at $15 a share, and that's when you can buy them at. Well, so long as once the stock is above $15 per share, then an executive will be willing to buy those shares at $15 per share. Because what happens is if they buy them at $15 a share and the market is at say 25, they make $10 per share for every share. And the part of the reason that they do this, and some of this has to do with companies like Microsoft early in their business, it allows for cash poor companies to compete for talent. So they didn't have a lot of money in their early years, but there's a lot of Microsoft employees that got stock options as opposed to cash pay, and they now are millionaires because obviously we know what happened with Microsoft. And what it does, the second one is, particularly for executives, these stock options align better with the organization because the main principal responsibility for an executive within an organization is to increase shareholder value. And typically that is measured by the value of common or preferred stock in the open market. In other words, stuff that's traded on the NASDAQ or the New York Stock Exchange. So they do these options in order to align their incentives better with what the owners or the shareholders want within the business, because it's good for both the executives and the shareholders. So it's a win-win. That's why they award these options. So what do we do for distributions of shareholders? Um, we pay them out in dividends, and we'll talk about that in just a minute. They repurchase shares. That's a treasury stock, and then they can also get dividends without reducing their shares. So let's talk first about stock repurchases or treasury stock. So organizations buy treasury stock. They buy back their stock is really what this is saying. So when they buy it, they would debit treasury stock. So it's a contract stockholders equity account, and they would credit cash. But why do they do this? Because they want to buy out ownership of one or more shareholders. They want to reduce the size of the corporate operations. The next one is they want to increase the value of the share. That's this next one says And here, this is for employee stock ownership plans. If you work for a company that has an employee stock ownership plan, and typically that way that would work is you would put in a certain amount of money and the company would match it. Maybe you put 5% into company stock, and the company is willing to match your 5% in company stock, and they will give that to you. Um, if they want to do a business combination, and if they want to reduce an unfriendly takeover, and typically that's going to happen when your stock value is low and somebody else is trying to buy enough of your stock to actually take control of your business. So how does it look? You might pause the slide here, but what this really is it's talking about how they account for treasury stock and what we do. And we're going to look at the journal entries on the next slide. We're going to look at the purchase of treasury stock, the resale of treasury stock, and another sale of treasury stock. So you have one purchase and two sales. So let's take a look. The first one, here's what we talked about earlier. They bought 1,000 shares of treasury stock and paid $15 per share. So they cash one out and they increased this treasury stock, which is a contra equity account, by $15,000. The next one, they sold treasury stock and they made money on it. They sold they sold 500 shares at $18 a share. Remember, they paid 15, so they sold 500 shares at $18 a share. So it's $9,000 here. They're taking this out at the $15 per share times 500 shares, and the calculations are in the lower left. And the difference is an additional paid in capital treasury stock. This last one, you notice what happened here. They sold treasury stock 400 shares at $11 per share. So they only got $4,400. Well, what that really says is they lost $4 per share. Well, the rules say, the GAAP rules say that you have to extinguish your paid in capital first, and then any difference or any loss goes directly to retained earnings. So you have a $6,000 credit to treasury stock. And so you can see the calculations that you have here. Okay. Sorry about that. Hold on just a minute. The purchase of treasury stock does not impact the equity accounts on the issuing corporation unless the corporation itself is the purchaser or seller of the stock. And although the accounts aren't changed, they must maintain who own the shareholders. And this last one is they have to maintain who are they have an independent stock transfer agent. So when we have retirement of treasury shares, they'll retire them. In other words, these shares can no longer be traded. So they buy them back, and they're not going to reissue them. Many times this will happen when a corporation is going to go where they were a public corporation, publicly traded. They may say, well, we want to go private. And Best Buy is an example of that right now. If you're familiar with them, they've been buying up their shares of stock in order to go private. And they say, well, what's the advantage of being a private corporation? They can make decisions that are much more long term, and they're not influenced by shareholder uh, by trying to maximize the value of shareholder. Because a lot of times, if you want to make long term decisions, it costs the company more money, and it has an adverse impact on the value of shares in the short term and maximizing shareholder value. So they might want to go private. Dividends. Dividends are, you have three different types of dividends. You have cash dividends, stock dividends, and stock splits. This is a distribution of cash to shareholders. This is a distribution of additional shares. The second one, the stock dividends. And the stock split just changes it's a transfer of additional shares of stock to the corporation, but it doesn't change equity at all. It only changes the value of the par or stated value of the stock if you do a stock split. Cash dividends. You have three different dates for cash dividends. You have a declaration date, a date of record, and a payment date. The only two dates that are really, there's three different, the reason they're different is the declaration is when they say that they're going to pay. It is when they declare. The date of record is when they pay, is when they say shareholders of that date are the ones that are going to get paid. And the payment date is when they actually send out the checks for the dividend. So let's take a look at this one. And you can pause your slide here a little bit for this Kingsmill Corporation. But let's go to the next slide and take a look. What we're going to do is we're going to look at the journal entry for date of declaration, date of record, and the payment date. So the first one, they declared a $2 per share dividend. This is the declaration date on the 15th. So what they do is, remember, retained earnings is where you retain profit. So they debit retained earnings 5,600, and they credit dividends payable for 5,600 on the date of record or date of record. There is nothing that they have to do for number two. The date of record, all they're doing is checking to see who owns those shares and who's going to have the right to get that distribution. And then finally, on the payment date, you're canceling out the liability that you established up here. You're debiting the liability and you're sending out cash. Pretty straightforward. And you notice dividends are not paid on treasury stock, and that's an important thing. Now, dividend policy is really driven by what they want to do as an organization. Some organizations, one that I worked for was called Dean Foods, and they said, well, we had a dividend every year for the last 30 years or something crazy thing like that. So that governs exactly how they declare and send out their dividends. And so they want to try and maintain that. And they also want to look at it based off of what they expect is going to happen with the organization, and if they want to have some type of long-term stability in their dividend policy, because that determines the type of shareholders that are going to buy their stock. That's what this thing down here talks about. And you have liquidating dividends, which essentially is where they're going to, when they liquidate the capital stock of the business and they're going to liquidate everything that's in the business when it's a dissolution, well, that's where they're going to get paid their value of what they own in the corporation. Stock dividend essentially transfers shares of stock for the corporation. And typically an organization is going to do that where they don't have a lot of cash again, but they can do a dividend. And there's two different types. A small stock dividend is under 25%, and a large stock dividend is greater. And they're accounted for differently. We're going to talk about each one. So how do we account for a small and a large stock dividend? Well, this one we're going to use for the small stock dividend. You notice what happens here? They debit retained earnings at 5%, and we're using the cost method here, and we're going to use the equity method down here. So you have 3.6 million, 3 million in common shares, and then 600,000 in preferred stock. And a large stock dividend is just a straight, nothing in additional paid in capital, just goes straight, and it's not at the market rate. You notice here it's at the market rate, and here it's at the equity rate. That's the difference between the two. Stock split, all it does is it changes the number of shares that you have outstanding, but the proportional number of shares stays the same. So if they split stock, if you had a 2-for-1 stock split and you had 1,000 shares, you're now going to have 2,000 shares. And the only thing that changes is if the stated value of the par value or stated value was $1, then what happens is if you have a stock split, the stated or par value, if it's a 2-for-1, is going to go in half or whatever the ratio is. And so it increases the number of shares outstanding, but it doesn't change any of the balances in the equity account. And it just changes the par value and the number of shares outstanding. They're noted in the corporate records. Preferred dividends. Preferred shareholders get a dividend preference. And they have two different types. They get current dividend preference, but they also have a cumulative dividend preference. Cumulative means that it adds up, and then they have a participating dividend preference. Current dividend preference simply means if there's a declared dividend, if there's two classes of stock in a corporation, a preferred and a common, then preferred gets their shares, their dividends before common shares get theirs. And in years where there's no dividend at all, neither one of them can get a dividend. Cumulative means that for preferred shareholders, if they have cumulative dividend preference, that they can get dividends going back multiple years, and they get preference over common shareholders. So if maybe a preferred shareholder did not get a dividend for 4 years, and this year they declare dividends, and whatever the amount is that the preferred should have gotten, they have to take that out for the preceding 4 years before they even think about giving a dividend to the preferred or to the common shareholders. So here's an example of that, and you might want to pause the slide here again and take a look. But let's look at the differences here. So what happens? This is a cumulative example, right? And it says that available dividends 9,000 to preferred shareholders 9,000. Common shareholders got nothing because the preferred shareholders got some money. The next one, that 12,000 was available. Well, 10,500 went to preferred shareholders because they were short 1,500 here, and basically they the 6,500, and you can kind of work your way down and take a look at the calculations because it deals basically with dividends and arrears. And just read through this and it'll give you a perspective on exactly how the calculations were done for preferred. But it gives you an idea that preferred shareholders get dividends that go back. If you're cumulative dividend preferred shareholders participating, some preferred stock dividends are not restricted to a fixed rate. In other words, they have a little bit of common preference in them, so they can get more than what is just on their than what's stated on their stock. Just like how we talked about that it's similar to debts and bonds. Retained earnings is accumulated earnings or loss for the entire life of the corporation, less any dividends paid out. And generally, it looks like this: beginning retained earnings plus net income minus dividends equals ending retained earnings. Pretty straightforward. It looks like a statement of retained earnings. Organizations have restrictions on their retained earnings sometimes, and it might have to do with bond covenants or rules that are established, or the board of directors may set aside a portion of retained earnings just because that's what the rules they want, or state law might require it. And sometimes they may have a reserve account for restricted portion of retained earnings. They might establish that separate in their financial statements. If they have prior period adjustments, the standards for the prior period adjustment say that they're going to go directly to retained earnings as opposed to going through the financial statements. So if they made a mistake in their financial statements, typically they're going to go straight through retained earnings and not go through the income statement, because you don't want to distort the income statement. It really depends on what kind of example or what kind of error it is. So then they have the FASB has something for other comprehensive income. And it really has to do with changes in assets and liabilities as a result of non-own transactions with non-owners. And it is allowed for those gains and losses in some of the non-owners transactions to go directly to stockholders' equity. And this is going to be a separate and distinct account. It's going to say other comprehensive income, and they're required to include the gains and losses along with net income in a measure called comprehensive income. That's that last part. And it permits comprehensive income to be reported in one of three ways. Currently, the most popular is to include in the statement the changes in equity as a column of other comprehensive income. And it also says there's a second income statement which begins with net income and then shows the unrealized gains or loss and for available for sale securities, and then totals other comprehensive income. And the last one is to look at a combined statement that has both of them in. But the most important thing you want to know is to have to report other comprehensive income and disclose it on the equity section of the balance sheet. Equity analysis, there's certain ways that they want to do this. In equity analysis, shareholders want to know what they expect their change in value of stock to be, and also what they're going to get distributed from a profitability perspective. And there's a couple different things. There's one that's called return on equity. And really, this is for common shareholders. You're going to take net equity less preferred dividends divided by the average common equity. And this is going to give you a percentage, and you have a similar calculation, but you're looking at the average shares outstanding divided by the net income less preferred dividends. So the denominator in both of these equations changes, but the numerator remains the same. And here's an example of that, and we can take a look at what this is. And you can stop this and take a look, but it gives you a lot of data here. But let's take a look at what it tells us. So the first thing we're looking at is return on common equity. We're taking the return on common equity divided by the shares, the dollars outstanding, and it gives you a straight percentage, 1.28%. And then the second one says, okay, what are the earnings per share? That's the money that they have available that they can pay out to you, which is 75 cents per share, based off of what the corporation makes. Those are the differences between the two. And you can look at the calculations and read through this as well. But this just kind of gives you some benchmarks. And typically, I think this number is probably low. You want to look at this more like maybe 5 or 6%, but you got to look at these in combination because your return maybe is a little bit of both. So you can't just look at one or the other. You can't look at them in isolation. And they have a couple others that are going to be a dividend yield and dividend payout. And it's dividends per common share divided by common stock price. So this is going to tell you how much you would make based off of the dividends that you pay. And obviously you want it to be somewhere north of 5%, probably closer to 8%. And dividend payouts is how much dividends did they have and what was their net income? In other words, what percentage of what they made did they give to the common shareholders? And then you have a couple others. Stock repurchase payout. I'm not really going to go through these, but you can kind of look at the things that they have and kind of get an idea of what these are. But these are other ratios that you will look at. And here's the same kind of stuff for Capital One. And you can look at each one of these. The first two says that the dividends per share, 1.38%. So that tells you that you make 53 cents per share versus a common shareholder price of 38.34. This number seems pretty low. I don't know that I'd want to do that. And it tells you that they paid out 24% of their value of stock. And the stock repurchase calculations, you can see these as well and get an idea of what goes on with those. You want to look at the ratios and you want to look at them over time. That's a big thing. Time in comparison also to their industry peers. And you kind of have to look at them in combination because you have to make certain of what is happening with that company and if it makes sense for you to purchase, because what you're really trying to do is make an evaluation on whether or not you want to buy stock from that company or not. And that's the end of chapter 10. And I look forward to seeing you in chapter 11. I hope you have a great day.